this afternoon at our virtual conference. Joining us from the company, we have Mark Foley, President and CEO, Toby Schilk, CFO, and Jessica Serra from the IR team. Thanks so much for being with us. Really appreciate the time today. Mark, I'll turn it over to you quickly for some opening remarks before we go into the Q&A.
Great, thanks, Terrence. Appreciate the opportunity to be here at the conference today. So maybe a couple of quick framing comments. After sort of 20 or so years of development, we're on the cusp of the approval of our neuromodulator. We recently announced that the FDA will be inspecting our facility before the end of June, and so we're obviously very anxious to get that product into the market initially in aesthetics, and then our therapeutics pipeline continues to evolve, which I know we'll talk a little bit more about in this fireside chat. Partnered with our neuromodulator in the aesthetics market, we've added the RHA filler line in the HintMD fintech platform, which we think gives us a really good suite of services in the roughly $3 billion facial aesthetics market where we compete and play. Last year, we shifted to becoming a commercial stage company. Our 2 full quarters of launch into our RHA filler line and along with the HintMD platform. We're also well capitalized. We added to the balance sheet over time with a convert and some additional equity offerings. And as of the end of Q1, sitting on $387 million of cash and cash runway into 2024. So we're really excited about where we're positioned. This is going to be a really important and another transformative year for the company. And then in addition to sort of the neuromodulator in our aesthetics and in our therapeutics, we've obviously got the biosimilar to Botox program that we have with Viatris, along with our partnership with Fosun in China. So with that, when I turn it over to you for questions.
Great. No, congrats on all the progress and the move to commercialization. I guess as you think about the forward here, maybe just, again, you guys were opportunistic on the BD front. You acquired HintMD, got a filler product. Do you feel like you've got enough on your plate now, or is there an opportunity post, the DAXI approval and launch here that maybe you could be somewhat more opportunistic on the business development side? But maybe just help us think about continuing to build out here. Or do you feel like you're in a pretty good place here and you guys have enough going on at the company?
We certainly feel like with the assets that we've assembled in the aesthetic facial side, that we have the assets that we need to compete and that we think can deliver good, consistent growth that's going to be attractive to investors on that franchise and as we go forward. But our aspirations are bigger over time. We want to build a great company, not just in aesthetics, but also in therapeutics and wherever we compete. And so, we will continue to be opportunistic. We're always going to be very thoughtful about capital allocation, where we put the dollars. And given that we need to make sure we execute well and that we're prepared for the launch, there's going to be a pretty high bar on anything else that we would do at this juncture, because it's not just competing for dollars, but it's competing for focus, attention, resources, execution. So again, we'll continue to be opportunistic, but we really like where we're positioned today.
Okay, great. I think another key topic is obviously, the COVID recovery here. As you guys look at kind of the end markets out there, maybe just talk to us about what you're seeing kind of May versus April, and then how are you thinking about the shape of the second half? I know you're in a little bit of a unique situation here because you're in a newly launched position. You have another product potentially launching later this year, but just as you think about the aesthetics market, what's going on with the recovery?
Yeah, and I think there's a lot wrapped in there also because we're not only bringing a new product to the market, but we're in sort of a launch phase and we're very targeted. So the accounts that we're going after, we're naturally are biasing ourselves to those that are open and willing to see us. So there's some natural selection where we're a little less impacted by the broader market. Having said that, if we wind the clock back in time, part of the reason we're excited about where we're positioned is that the overall aesthetic market, if you go back to the pre-pandemic, was robust and growing in a pretty healthy way, high single digits, low double digits. And all of those growth drivers, a younger population trying to, delay the aging process or, prejuvenation, more men, people living longer, trying to retain the best version of themselves, all of those trends combined with fairly low penetration in the market continue to drive growth. So to us, the pandemic sort of put a time out, but now we're seeing pretty healthy return to kind of those, pre-COVID levels. So overall, the market is very healthy. Demand is strong. It impacts us less again because we're very targeted with our prestige launch strategy and are going after accounts that kind of see value in offering something different, having higher priced offerings, and we're being very disciplined in our launch. But we come out of this feeling very encouraged about the growth trajectory and the dynamics of the overall market. And so as we move into the back half of the year, it does feel like we've kind of returned to pre-pandemic levels, and we should start to rebase off of that for sure.
Okay, that's great. And what are you seeing in terms of, virtual versus in-person engagement now at different accounts? Maybe, how does that differ across geography in the US, or is it pretty much, similar across the board?
Yeah, I mean, there were definitely certain pockets, New York, San Francisco, Pacific Northwest, some areas in the Midwest as well, that were a little bit more challenged in terms of access to accounts and sort of how they were managing through that pandemic. Again, we had the luxury a little bit of going where the business was because we were in launch phase and reps were only calling on so many accounts. So again, there was a bit of a selection bias. And I do think that there were some accounts that, the access was more regimented, meaning that in the past you could just swing by an office, check on things, how it's going. They wanted it to be scheduled. They might control dates when they would see reps and other things. So it had to be a lot more thoughtful and planned. And some of that certainly still does exist. And I would expect that there will be some, accounts that do adjust a little bit to, hey, maybe we like this where it's a little bit more controlled and stuff. But overall, we've had pretty good success in getting access to the accounts that we're engaged with. And we have used some of the virtual tools to facilitate and create a little bit more efficiency in the process as well.
And do you think some of that virtual efficiency is going to stick with you guys as you think about the forward? Or again, assuming we get back to fully normal in second half of the year, do you think it's just going to be kind of like it was pre-pandemic? Are there any learnings that you guys think you could leverage?
Yeah, I mean, I do think there will be some advantages going forward. I think anytime you go into this type of environment, you try and look at, what can you do to enhance productivity, and that makes sense. I think the biggest area will be training and education, particularly in a launch phase like ours, where you've got what's going to be, we expect a pretty big demand for our products and still a need to sort of train and educate. That was one of the reasons, even pre-pandemic, that we leaned into Nashville and created this whole training and experience center. It's not just about that physical experience, but the IT investment that we made so that we can beam out trainings and host people in and create more of an interactive environment, I think is going to be here to stay. I still think this is very much of a people business. And so I would expect that the in-person interactions, whether it's trade shows or in-office visits or other things, is going to continue to be really important here. But I do think we are going to be able to leverage this, and our field team will be able to leverage this in ways that will be more efficient for everybody.
Okay, great. Maybe if we move on to the, the filler launch, obviously your first set of products here. Again, in the end of the first quarter, I think you were up to about 1,500 accounts here across your products and services. That grew from about 1,000 at the end of year-end 20. And so it looks like, again, you're seeing kind of breadth and depth here driving the base. But anything you can comment in terms of the forward outlook here, just remind us, like, what's the scope of accounts you're going after? And then maybe as you think about that reorder rate, any early signs there that you're seeing across the accounts, and how to think about that on a forward cadence.
Sure. I mean, first on the market in the US, we think about as kind of 40,000 injecting accounts. And of that, we're targeting the top third or so, call it 15,000. And we would expect that through that effort, we'll probably end up doing business with about half of those 7,500 accounts. Of those kind of top third, 15,000 accounts, they do more than 50% of the business. So there's definitely a weighting of the volume in those accounts. And so we're methodically working our way through that